multiple factors. And when we look back at our successes and our mistakes, invariably in our mistakes we've gone wrong on the softer factors. We've gone wrong on that one value destruction step that a company which had everything else going for it, that one step really destroyed. I hope it was probably not the answer you were looking for, but
we got the 80% of the answer except what Ajay asked. But I think with the principles what you mentioned, that if we can really digest this and understand and we can evaluate from this perspective, I think the names we can identify ourselves also. And as I think one very important fact which Iqbal mentioned is the weightage of that particular script in the overall portfolio, which many a times either it gets over weighted or it is underweighted. So that aspect I think is something which I will call it as a skill and art, which in yesterday's valuation session we saw that many of these are something which like an artist, it comes with only experience. Maybe many of us will be able to learn this from investors like you.
On a lighter note, most of the artworks of the great artists are only appreciated after they are no more.
Which is not the case in your case.
Well, it is not that well, I said.
So Ajay, coming back to you, nowadays, particularly from these acquisitions of various software companies, we are seeing a lot of consideration is plugged to the future income streams, either linked to EBITDA or linked to some of the other parameters. So are you seeing a lot of impact on account of that in terms of regulatory, particularly if it's a cross-border transaction, or even if it is a local transaction in the income tax department for the seller, whether there are any issues which should register?
So I understand you're talking about earn-out component. So increasingly, I think it's becoming important component because in most transactions, value is expected to come in 2 to 3 years. So when someone asks us when is the right time to sell the company, right time to sell the company is not when you have matured in your valuation or in your performance. It's probably 2 to 3 years before that. Because that's where you are able to maximize the value in terms of getting the right multiples. Increasingly, investors are getting more and more, while they acknowledge that yes, we have everything going for you to achieve that kind of a value creation that we are talking about. It is something that is equally important that you actually achieve it, and some portion of the upside that you are asking because of that, you get it once you deliver those numbers. So this is something which is important. I think on a regulatory side again, the current regulations now permit a lot of these kind of payments. There is a escrow and the mechanisms and there are certain issues around it, but largely you can work over it and you have a very clean solutions around these points. Even on the tax side, yes, there have been some issues that people have faced on, department trying to tax the entire consideration even without it's not being realized. But we believe that will not prevail. I think money can be taxed only when you want that. But it's going to be more and more important, and you would see much more of that in many more transactions.
Raj, while dealing with various of these transactions as an investment banker, do you see resistance, by the target company for sharing of data at the initial stage of discussion? See, once the NDA is signed, I think the comfort is definitely there. Of course, the validity and legality of NDA, Sharad is the right person to guide us on that. But we have seen many times that there is a huge amount of resistance to open the gates, because many a times the term sheets or the initial MOUs are not tightly geared so that if there is a reversal of the discussion, there is no financial implications linked to it. So after knowing a lot of information, many times I acquire back out after getting the relevant information. So that somehow how do you see as an investment?
So
first point on NDA, with due respect to Sharon and any other lawyer here in the audience, unfortunately in India, NDA has no meaning. People just sign it and don't respect. If NDAs were meaningful or people were really following them, the spirit of NDA, then you would not have found every deal in the newspapers much before even the deal is concluded. Because the moment you have three different sets of advisor, take my word, it's a public. So people are very scared. So nobody really pays any attention to NDA, though everybody does NDA in case if legal recourse has to be initiated, and that it comes. With regard to the information, you are right. So the initial stages, people are very hesitant to share the information because first they are not very sure whether the transaction will happen. Number two, whether you are really committed to the transaction or this is the information gathering exercise. So it depends. It also depends who is representing who, how serious, what his own credibility or advisor's credibility is, and so there are a lot of soft factors and a hard factor. But sometimes, generally the information is shared in two stages. First, at the initial stage, and then you talk about the various parameters. If the valuation is in range, and obviously everybody knows that due diligence, and then things may happen or may not happen. But at least if there is, so some information will be shared, so you can tell how serious you are about the transaction or not about transaction. When you are doing a auction, where the transaction has to be done, multiple, suitors are there. Then you do for the non-binding stage, certain information you share with them, and you tell that, okay, based on this, please indicate whether you have interest or no, and if you have interest, at what price, what value. And then you shortlist to the seniors or you believe and then you start opening up much more. But your point is very valid that people are hesitant to share the information on the day one, and rightly so.
In your experience, when you invest in a company and suppose the stake is substantial, do you see a lot of changes in the key management team members? Of course, you clarified that you don't interfere in the day-to-day operation, you just give suggestions, but because of some factor that they feel that now there's an investor and we will be more answerable, are you seeing a lot of exits because of such changes?
No, that has not been our experience. If anything, actually having an external investor helps a company to demonstrate both internally and externally that it is more institutionalized or it is more professionalized. And the management team is also more comfortable with the fact that the promoter is not going to be allowed to do what the hell he wants. Within reason, of course. And therefore, we don't see such things happening. Having said that, exits of senior management teams over a period of time are a reality which we all have to adapt to. And companies have to take requisite steps to ensure that their processes and their systems are geared to deal with those kinds of uncertainties. And over the years, I think we've seen that no one person is irreplaceable. And we've seen that whatever happens for the best. So if somebody moves out, maybe it is for the best, for all concerned. You do not want a person who is only giving his half-hearted best to the company, no matter how good he or she is. So you want everybody to be fully aligned and to have the same belief and conviction. And if they have that, that's not an issue. Also, most investors, when they come into a company, they try to ensure that the interests of the promoters, the investors, and the key team members are aligned in some fashion or the other. There are various mechanisms to do so, and with that, at least in the top management team, there is that expectation that significant value will be created by such measures, and therefore we don't see exits.
Maybe at this stage, if we have any questions from the floor, we can take before we go to the final session. So, can somebody give the mic? Just because.
So good afternoon to every one of you. My question is to Ajay, since you people are dealing more in global M&A thing, like this BEPS coming. So how do you see the impact of BEPS, this base erosion and profit shifting, on the global M&A? And secondly, GAR is also likely to come from 1st April in India. That could impact the M&A scenario in India also. So what's your take and how you should advise your clients so that we can plan in a better way so that the impact of this can be diluted in some way? Thank you.
So, you are absolutely right. Provisions like GAR or BEPS would have impact on some sort of restructuring, especially corporate restructuring or internal restructuring that you may say, which is being done from within the group or intra-group. You have to have a very strong cogent reason to say there is a commercial rationale for what you're doing, and it's not driven by a mere tax as a reason for restructuring. So far as that angle is taken care of, or that angle is something which is not a primary motive, we believe that should be okay. However, like any other provision, this will have its own teething issues in terms of how different things will get interpreted. And but this is something which has been there in most parts of the world. There are strong anti-avoidance provisions which are there in most global statutes that we see. So, in the long run, I think things should settle down.
There is a related issue to BEPS and it's around transfer pricing. Transfer pricing is a double-edged sword. The Indian AO raises the price, say from 100 to 150 and 200. But the corresponding deduction is not given in the other country, for example in USA. So this is double taxation. This aspect has not been highlighted anywhere, neither internationally nor in the Indian circle. So this is a very crucial aspect and huge amounts are involved.
Yeah, it's a more specific tax issue than a restructuring issue, but at least in one transaction that we have recently come across, where there is a similar kind of a transfer pricing issue. And what they have done is they have gone to, I forget the name, competent authority under the treaty, which is, MAP, yes. Mutual agreement procedure, where the two tax authorities of India and US, they come across, they sit on the table and try and figure out what to be the right thing. Because rather than me fighting, that both tax authorities internally fight and agree as to what is the right price, and I will follow that price. Because I don't care, I did in my best way. US believed that yes, that's the right price. India believed no, that's not a right price. Why don't you internally fight with the room and figure out what is the right way? In which case, you get a corresponding credit in the other country.
Just like there is provision in the Income Tax Act regarding partnerships, if there is a decision regarding salary or interest, then there is rectification under section 155 corresponding.
You are dealing with same income tax department. Here you are dealing with two different countries. So it will have its, yeah, but it's a similar law.
Say that when multinational agreements are being signed, and it will be signed, I think, in this very year. So there should be a provision to avoid such double taxation. There are some decisions already. There are 3 or 4 decisions on this point, some in favor, some against. But they do not carry much authority in the absence of
Someone from tax guy will have to answer this.
Maybe we can take it offline. Yeah. Any other questions?
I have only one question to Raj.
Yeah.
Now we have been talking about how to go about the duty and identify the social aspects. You or people, if you can throw a light on what are those, it is a whole process. What are those indicators which is showing us this time to call back or to call out the transaction? These are indicators because many times even knowing that there are some work page we work on the transaction and finish. Knowing that we don't realize that it's time to go back to the transaction. So what are those indicators during the process of it? This shows us it's time to call back and not to go forward for the transaction.
So if I understood your question, you're asking what are the softer issues which one should be concerned about before doing the transaction? Is that?
No, my question is, when do you feel like you have to go back and you have to walking off of the transaction rather than going and pushing the transaction back? What are those points?
So let me try to answer this. One of those would be that there are some regulatory issues like, for example, Ajay was saying if a multinational is acquiring and there is obvious case of bribery where you have been indulging in some bribery either to get the orders or do the business or something, or then obviously that's not compromisable. You can't do anything about it. But that's obvious case. So you will walk out. The second issue would be where you see the things are very fraudulent or fudged about and all that. You would not like to do the transaction there, so you walk out. Third issue would be the softer issues, so when you are doing the due diligence, and these days there's a lot of focus on the non-financial, non-legal due diligence. What I mean by that you do a lot of operational due diligence, you do a lot of the plant due diligence, environmental due diligence, as I was saying, and then if you go and do the plant due diligence and see the life of plant is not what you thought of, or you will end up with, so you do. And fourth important issue to my mind would be the HR related. So a lot of people when these days we see, and when if I'm an acquirer, I want to meet the senior management, I want to, obviously I have to create time and everything has been done, otherwise, and that tells you sometimes people are very reluctant, they don't want you to meet, they say, okay, you meet only X, so Y, and you want to meet G, all that. So that HR related issues are very important, because you don't want a situation then on day one you take a manufacturing unit and tomorrow they so that's we did a recently very large transaction where this issue was very important, and we just wanted to make sure that the acquirer is acceptable to the people at large. So otherwise, and that was important from seller's point of view also, as well as from the acquirer's point of view, because you don't want to be, because you will have thousands of the problems to deal with when you acquire. Government of India doesn't make it that much easy, and then you don't want any problems of this software issue, which could be very complicated. And once they start, a lot of external agencies come into play, and all that. So you will.
I would like to add here, what we do and what we advise our investing companies to do is also, before entering into any such major game-changing transaction, to build a transaction hypothesis where you put your key assumptions, both qualitative and quantitative factors, and also your valuation and all of those. And then we ask them to say, of all the variables that you included in the transaction hypothesis, which are negotiable, which are non-negotiable? Where do you have zero tolerance and where do you have tolerance? So that transaction blueprint should be created upfront. Not that it cannot be modified later, but what it does is it gives you a very good roadmap throughout the transaction. It will include the softer factors both at the promoter level, the company level, the team members level, customer level, all of those factors are included. And then, during the process of the transaction, to your question of when should you decide a go no go, right? You decide on go no go either on any of the non-negotiable factors that you have set out upfront, or you find it to be a malified situation. Otherwise, the only adjustment that you should look for is an adjustment to the price that you are paying or the method of the transaction. Other than that, it would be frivolous to go into a transaction, walk down the garden path, and then be the runaway bride. And you are impinging your own credibility for the future. You will not be then taken seriously either on the buy side or on the sell side subsequently.
to create the hypothesis.
I have one question for both Utpal and Raj. Yesterday we heard inaugural speech of Donald Trump for America, in America, hiring in America. Now, a lot of companies in our country are actually depend on export and specifically US. Of course, they won't extract, for example. IT we all know really. Now, do you see impact of that in terms of any consolidation happening in this country? Or your thoughts would be some thoughts?
I heard his speech. So first, a speech is a speech. We don't know what exactly he's going to do.
Actually, it's repeated.
Yeah, that's true. He repeated it. But that's neither good for America nor for anybody else. So I really don't know how much it will be implemented. But if it is implemented, if he really decides to do what he said, then obviously it's going to have some impact, sort of on not only Indian company but everywhere else who are dependent on exports and US, where the US is the major export part.
You see still more as a rhetoric there.
Sorry?
You still see more as a rhetoric.
I think so, because we have seen in our own country, and when, let's be very honest, when the Prime Minister Modi came to power, there were all kind of people who were saying, this is going to happen, that's going to happen. And Mr. Modi, now the same people are saying, oh, he was a capitalist, now he has become the socialist. So people do change when they so I believe wider sense will prevail on him, and at least if you are, apart from his own speech, if you have seen some of his appointees and their confirmation sessions, they they were not necessarily in agreement with what Mr. Trump says. So I am still hopeful, but Trump is Trump, so you never know.
You expect the team to moderate it.
I hope so.
So I think there is a very good system of checks and balances, and he will need Congress support for any of his inverted comma initiatives. And I think we should not forget that corporates and business models themselves are also very adaptable. So given adequate time, they will adapt. For example, TCS today is probably the largest single recruiter amongst IT companies in the US. So it's not as if it is all offshore. There is also a lot of on-site work which is taking place, and it will cut both ways. And therefore, what we were talking about earlier, the soft factors, the adaptability and the agility of the management teams or the promoters that you are backing is probably more important than most other factors. They have to navigate in this dynamic world or volatile world. As an investor, you cannot navigate it as well. You have to bank on that management team to navigate.
When you are doing M&A exercise, are you looking for the benefit of all the stakeholders or only to the buyer and seller? Because we have seen many transactions where the common retail investors have suffered, though the promoters have got the cream of it.
I'm not too sure I understood your question, to be honest with you. Are you talking about, in some cases, promoters going away with the differential benefits? Is that what your...
Yeah, the cream of the transaction is taken away by the promoter, whereas the retail investors are left high and dry. I mean, not benefited to the extent the promoter gets benefit.
No, in any transaction, all the shareholders, including the promoters, get benefited in the same ratios, except if there is a separate sweetener which has been offered to the promoter or the controlling shareholders, which happens sometimes. For example, earlier promoters were allowed to take the non-compete fees and all that, which has been disallowed now by SEBI, so scope is not there to do it. I believe that used to be done to circumvent that provision. Some people were using 390, the 391, 394 scheme, and they said this is outside the purview of the SEBI, and that happens. So SEBI has come back with the recent amendments, and now they are saying they will scrutinize the schemes with much more greater focus and all that. So I think the whole regulatory environment is such that it's becoming more and more difficult for a shareholder that is being promoted to get something very different than the retail shareholder will get. Now, if the transaction is good, then it's good for all the stakeholders, including the acquirer and the retail shareholders. I mean, or if it's bad, then it's bad for everyone. But when we do the transactions, we really don't do the transaction, or that's not the starting point that it's good for promoter or acquirer or not good for promoter. It has to be good for all the stakeholders.
When we are seeing when there is a business spread and not a share swap, then those type of transactions may affect the retail investor.
In some cases, that may be the case, but my experience is that that's not really the common, that may be the exception.
Also, retail investors and all, they look at the short-term impact, saying that what happens in the short term. But a lot of these things are done from a long-term value creation perspective. So,
Ajay, I think there is a specific query to you. Maybe after the session is over, you can just go through because it's a little detailed. So if you don't mind, I have handed over, but I think it requires a little more elaboration. So as we are coming to the end of the discussion, I was just thinking, I throw this open to all the three panelists, that what are the changes you feel in a regulation or environment, procedural environment which we are having, needs to be done to encourage this kind of restructuring or eminent, as we may call. Some of the things which comes to my mind is this restriction of section 72A, allowing only manufacturing to carry forward, companies to carry forward the losses. Why not service industry? Why not broking? Why not finance companies? Maybe they are also contributing substantially to the economy. So why they are there is restricted? Secondly, this what we are seeing in Tata Docomo. If two parties have commercially agreed, why to restrict and they can't remit this kind of work? Some of the thoughts which comes to my mind. So another thing is banks cannot fund an acquirer to help them to acquire a company. So these are some of the things which comes to my mind. So maybe quickly we can have one round before we hand over the session back to the chair. So Ajay, you want to start?
So slightly more at the generic level, I think
Yeah,
what you're thinking is absolutely right. So one is ease of doing business, and that is something which will really help, and it's happening. I think we've seen significantly in terms of things getting easy, but I think still not needs to be done. Second is taxation. There's a whole list of taxation in terms of merger, group company paying taxes on an entity basis. These are very good practices across the world. I think we really need to look at that. And third is exchange related. So, for example, foreign company